Good morning, everyone. Welcome to this event, and thank you for your interest in kind of offshore investing and particular infrastructure investing. My name is Marius Botha. I'm the CEO of M&G Investments in South Africa. It's my second week in the job, so bear with me. It's going to be, but I'll give you just a little bit of background, just kind of to frame things. So I started my career off here in South Africa at Old Mutual. So I'm South African, right? So kind of born and bred South African with a name like Marius Botha. You can guess it, right? So and I really want to say it's wonderful to be back in South Africa after spending 20 years outside of South Africa in kind of various investment risk management roles. I mean, previously, I do come from our group function in the UK. So just a kind of bit of background. I had a global role there as Chief Risk Officer for M&G Group. M&G, as I think you might know, but I'll say it in any case, we have 330 billion pounds of assets that we manage globally. So to put it in the South African context, that's about 8 trillion rand that we manage globally. So we're a well-respected international outfit that kind of invest in equities, fixed income, multi-assets. We also have a very large 70 billion private assets book that manage all the way from real estate to infrastructure, debt, equity, private lending. I think with that kind of in the back of your mind, kind of setting the frame of us being an international player, for me to kind of be in with that firm for a while and coming to South Africa to help kind of grow the business here is very exciting for me personally. So I really want to thank you for your time today. Hopefully you'll find it interesting what we have to say here. We've got some excellent speakers, Musandile, Alex, who is very excited to talk to you. Hopefully you'll see their excitement throughout. But I'm going to hand over to Nalini, who will kind of take us through the agenda and do further introductions. But lastly, sorry, it's really good to have Sonia here. So it's good to have asset allocators here. She's also going to talk to us. Sonia, thank you very much for agreeing to talk to us. And we'll look forward to hearing from you.
Good morning, everyone. Thank you very much for joining us today. And it's good to see so many familiar faces that would have joined us at our event last year. This is our third iteration of Global Investing, and this is brought to you by M&G Investments, South Africa. So, as we all know, South Africa has one of the lowest savings rates in the world. The average household savings rate in South Africa is currently at 4.44%, and that's been measured over a period starting from 1960 to 2023. Now, that's a very scary statistic, ladies and gentlemen. And as an investment industry, we are all faced with the important responsibility of helping our clients achieve their long-term investment objectives, whilst also navigating uncertainty and volatile markets. At M&G Investments, we understand that uncertainty is a given. And so we look to valuations as we aim to achieve better long-term returns on a risk-adjusted basis. A deep understanding of risk is a core pillar to our success. And our business has been around in South Africa over the last 30 years. Sandile Malinga today, our Chief Investment Officer of our multi-asset capability, will take you through our market overview, going into Q2 and the rest of 2024, touching on the key risks and opportunities across South African and global markets. Now, Investments 101 teaches us that with market volatility comes opportunity, right? And Regulation 28 encourages us to diversify our investments offshore by up to 45%. And this gives us access to a much broader investment universe and strategies. So regulation now also allows us to take up to 45% exposure into infrastructure to address the social impact needs of South Africans. However, this is not a uniquely South African imperative. It's a global one. At M&G, we believe that a focused and strategic approach to offshore investing allows us to optimize the returns generated from this very important asset class. As a global business, we manage unique and innovative offshore strategies, and these include strategies focused on social impact and sustainability. And we operate from various centers of excellence across the world in both developed and emerging markets. And as Marius mentioned, we manage in over 8 trillion assets globally in rand terms. And this allows us to deliver competitive and relevant solutions addressing real-world problems like social impact. Today, you will meet Alex Arujo, fund manager on the M&G Listed Infrastructure Fund. And yes, you heard right. We put infrastructure and listed in the same investment value proposition. This is an investment approach that we believe South African investors should consider, given the challenges that we face as South Africans. And perhaps we can implement and take some key learnings from Alex today as we look to invest in our own market and to make an impact in South Africa. So Alex is part of the M&G Global Equity team. And he's based in the UK, where we manage in excess of 1 trillion rand in assets in global equity specifically. 81 billion of that is invested within impact and sustainability strategies, and just on 63 billion within the listed infrastructure fund itself. And you will hear later on from Alex as he talks to you about the case for listed infrastructure globally. I'd also like to take this opportunity to welcome Sonia Sanderson. Sonia, thank you very much. She'll be joining me later on for a Q&A session where we will unpack how asset owners are approaching the asset allocation decision of whether to invest South Africa or offshore and what that allocation should be. So with that, I'd like to hand over to Sandile Malinga, who is Chief Investment Officer of our multi-asset capability. He has over 16 years experience in the industry, and he's been with us since 2014. Sandile has held many roles within our organization, within the investment team, from fixed income all the way through to multi-asset, having started in our business as a fixed income trader. He's also been co-head of multi-asset until recently being promoted to Chief Investment Officer of the multi-asset business. So with that, I'd like to hand over to Sandile, who will talk us through opportunities for global and local diversification. Thanks.
Morning, everyone, and thanks for joining us. It is, as Nalini suggested, a great privilege to chat to you today. And the topic they gave me was quite difficult, so I did take a little bit of a detour, and we'll do very interesting, look at very interesting data and graphs that are not in the traditional investment landscape. But I'm hoping to leave you with a little bit of optimism, obviously not too much because we have to be realistic, a little bit of a guide in terms of what you need to look out for in order to see whether some of the structural reforms that are being undertaken are actually biting and they're working. And hopefully, when I hand over to Alex, you'll be ready to receive a masterclass in thinking about infrastructure, how to do infrastructure the right way, and how we could possibly replicate that in South Africa. But as I mentioned, my topic was quite difficult. And the key themes that came out when we were chatting to our clients was they're facing two issues. One is the negativity of the news cycle and actually trying to abstract from that and trying to build robust portfolios is not an easy thing. And the second was to actually try and diagnose what the issues are. So what are we trying to actually think about? What are we trying to address? And why are we even attempting to look at this? What are the problems, the real world problems that investing in listed infrastructure, for example, aims to tackle. So, we did two things. We went and looked at some of the existing research and lent quite heavily on that. And we also looked at some of the forums that people participate in, those who are in positions of influence, and analyze what they are actually worried about. So without further ado, let's get started. This is a word cloud, and effectively what the World Economic Forum went and did was analyzed all of the speeches that were given at the UN General Assembly through 2023. And here you're looking for common themes. You're looking for common words that show up with increased frequency, and you're also trying to get a sense of what the themes are. And you can see, things like climate come up quite strongly, things like security, peace, and development. One of the things that we try and encourage investors to do is to diversify their portfolios so their portfolios can be robust to changes in regimes. Unfortunately, things like these are undiversifiable. Right? These are structural impediments that can only be addressed with structural interventions. And listed infrastructure is one of those tools that you can use to alleviate some of these. For example, if development is your issue, you need to build roads, you need to build bridges. That sits firmly in the development bucket and can be addressed by investing in listed infrastructure. But this is a bit, pie in the sky. It's not quite what we're looking for. It doesn't give us a sense of how these themes are connected. It doesn't give us a sense of what can we address in these themes so that these concerns can start being alleviated. So the second thing we went and looked at is something called a network graph. And this comes from some work, once again, out of the World Economic Forum. And a network graph has three important things, really. It's the size of the bubbles. So the bigger the size of the bubble, the more important that risk perception is to some of the participants. Not only the size of the bubble, but also the size of the interconnection. So the thicker the interconnection between the various issues, the more important and interconnected those two issues are. And thirdly, how far away those bubbles are from each other. So the closer the bubbles are to each other, the more related those issues are. And then you go and try to categorize all of these into themes that you can hopefully identify, have common drivers. And you can see, out of the participants of, the World Economic Forum over the last 2 years, and out of the UN General Assembly, and some of the speeches that have been given there over the year, the big themes are really, societal risks and what people are worried about. My eyesight's failing me. So in the red, societal risks, in the orange, geopolitical risks, and in the blue, economic risks, right? So those are all interconnected. But you've also got in the green, that's economic. What is that? Environmental. And in the purple, you've got technology. And those sit fairly far away from each other. But as the graph suggests, there are various mechanisms that connect the two. So all of these concerns are actually quite connected. So in order for you to start alleviating them and start to address some of these risks, you need to take a multi-pronged approach. And for example, societal and environmental, large-scale migration can be the mechanism or the transmission between those two issues, between different geographies. So, in trying to appreciate these complex issues and trying to address some of them, I think it's quite important that we appreciate how complex the problems are and how multi-pronged the approach is going to be in trying to address these. And coming to the theme of multi-prongedness, given that geopolitical risks and given that societal risks have been identified as some of the biggest issues that people are worried about, 2024 might be a watershed year. You've got a record number of people going to the elections, over, I think it's 4 billion, the number of Earthlings are going to choose new leaders in national elections across the world. 3 of the 10 biggest economies are going to elections. So, hopefully people will use their voices to hopefully elect leaders that will help them address some of those concerns. So on the left-hand side, you can see the story count of elections year to date. There's a clear increased trend. And as we go into some of the bigger elections, so India and America, it wouldn't surprise me for the story count to increase quite dramatically. And you've just got the number of people on the right-hand side going to elections. So it's no surprise to us that elections as a theme has become quite topical, even to our own clients. Now, we always say we don't know what the future holds. So in trying to appreciate these complex issues, we need to be quite humble about what we think we can say about market returns in turn. An example of this, which is something that we use quite regularly internally to keep ourselves honest, if you look at market returns over the last 2 calendar years, so 2022 to 2023, if you had been worried, for example, about recession and you had seen poor returns in 2022, if you had conditioned that, and that was your starting assumption going into 2023, you were probably not going to be well disposed to holding risk assets because the economy is going to go into recession. It's going to put pressure on corporate margins and employment, and returns are likely to be poor. What ended up happening was the complete opposite. So this is just to say, yes, you can appreciate some of those risks, but in the world of investing, those risks don't help us in any way to build robust portfolios. What we try to do is try to understand the fundamentals of various asset classes and try to understand whether we're being compensated fairly for economic risks that we can see. The non-structural risks sit in another bucket that probably has very little to do with what near-term to medium-term returns are going to look like. If you don't believe me that it's not just a flash in the pan, we went and looked at the performance of the JSE over time. So in the green line, in the gold line, you've got the price on a log scale. So this is growing quite neatly over the period, and we've also charted earnings. And 2 things stand out. South Africa has been buffeted by a number of events over the last 34 years. But the price of the stock exchange has been going up. So that tells you that, trying to build portfolios on the basis of anticipating events, anticipating what events are going to mean for price action is not helpful. It doesn't help. If you had simply looked at the earnings ability of these companies, you would have probably made the conclusion that's been vindicated by the price, that the price is going to go up. So yes, there have been many elections. I was chatting to a client yesterday, and if you look at the performance of the JSE, for example, over the last 24 years when we've held elections, in the election year, going into the election, typically what happens is the stock market actually falls and then has a massive rally after elections. It's only in one election where that didn't happen, which was 2004, and there were other things going on that dominated the narrative. But really, focusing on narratives for us is not helpful. But there is a place for it. Closer to home, when we looked at, what are some of the concerns that our own authorities and our own governments are concerned about, we did the same. We took the latest budget speech and created a word cloud out of it. You can see, infrastructure, budget, debt, growth. Those seem to be the key concerns that people are worried about. And once again, those are undiversifiable risks. How do you actually deal with those? Well, you need to embark on structural reform to ease some of those bottlenecks. But similarly to what other people are worried about across the world, infrastructure is typically one of the catalyzing interventions that help to deal with this. But you'll see on the next slide, we have an issue. So this is gross fixed capital formation. Quite a big word, as a percentage of GDP. This effectively tells us how much we're investing in infrastructure over time, and we've compared it to a select suite of our major trading partners in some emerging market countries. South Africa is that gold dotted line. We're lower than everyone else. So given that we've got a massive infrastructure backlog, we're spending way below what we should be spending. Some estimates indicate you should be spending between 25 to 30% of GDP in SA to catch up on the infrastructure backlog. So not only are we not spending well versus what we need, but if you compare us to some of the people that we're competing against in global trading markets, we're also spending less. Now, why is this important? Infrastructure typically leads to structural change, and structural change should lead to higher potential growth. Higher potential growth rates typically help companies improve their marginal return on investment. So if you're not going to be getting or producing or creating an environment for companies to be able to innovate, to trade with ease, and to bring in the necessary skills, if there's a shortage locally, then you're stuck. And I think one of the key learnings over the last 10 years in SA is, it's not just the level of spending, it's the quality of your spending. So if we look at what we spent the bulk of our infrastructure on, in 2007, we embarked on a build program to build 2 mega power plants, Medupi and Kusile. They're still not complete. They're running way over budget, way behind schedule, and barely meeting specification. What that means is the power that we're relying on to come on stream in 2015 and onwards has simply not arrived. So if you look at Eskom's available power on this chart over time, the green is what they can send out to us, which is quite astonishing. The blue is what you expect. That's planned maintenance. If you're running your grid well, if you're running your plant well, you should have a maintenance program to ensure that carries on going forward. The real issue, and really the nub of load shedding and the nub of poor capital allocation, is that pinkish guava bar. You should be alarmed when your unplanned outages are running at triple the rate of your planned outages, right? And this is where you start wondering, where on earth is the optimism? This guy came up and he said he's going to give us some optimism. We've been speaking a lot to Eskom, and we've been speaking a lot to the presidency, specifically the unit that's in charge of implementing structural reform, headed up by Rudy Dix. And some of the structural changes that they've implemented, so, functionally separating Eskom, why is that a good thing? Because if an organization is too complex and too big to run, you simply can't move as quickly as you need to fix some of the structural issues. And secondly, they needed to deal with the financial performance of Eskom. So, Eskom is caught in what's called a death spiral, a utility death spiral, where, the number of your customers is going down over time. The only way you can meet your operating expenses is to keep increasing the tariff, which then feeds into other people leaving the grid and finding alternative power. Now, because we didn't build the power stations as well as we should have, and because of some of the nefarious things that have happened at the various power stations, that guava line was increasing. You can see the trend increase in the first half of this chart. But from sort of May 2023, that's been going down. And the reason it's been going down is because the blue line has been going up. So planned outages, they've taken power stations off the grid. They've put in some repairs, maintenance capital, and are returning those, and those power stations are actually performing to spec and managing to ease the burden of load shedding. So I'm optimistic that that pink bar is going to reduce. It was at 37% in May of 2023. It's come down to about 28% in a mere 9 months. And if the trend is to be believed, it should be half of that by the end of the year. And that provides some comfort that, in order for us to be able to grow, the binding constraint on growth has been electricity. If we can ease that, and we can start doing other things that will help elevate our potential growth rate. But once again, it's not just about spending the infrastructure. You have to be spending the infrastructure in the right way, allocating it appropriately. And we simply haven't done that. But clearly, some of the structural interventions that have been taken are geared to addressing that. So, my cause for optimism is I'm hoping next year when we have this event, we'll stop talking about Eskom and load shedding, and we'll start talking about other more interesting and exciting topics. And on that happy note, I'm happy to hand over to my colleague, Alex Araujo, and he is going to give you hopefully a masterclass in investment, listed infrastructure investment done the correct way, and some of the themes that they look for when they try to build their portfolios, and how those themes go and address some of the structural issues that we identified on the first two slides. Alex, thank you very much.
Good morning, everyone. It feels a little bit incongruous on this beautiful day in this beautiful venue to be talking about all the world's problems. So I'm glad Sandile ended on a positive note. Unfortunately, I'm going to take us back a step and reiterate some of the challenges that we all face. But I do promise that certainly towards the end, I am the eternal optimist. I genuinely am. We will start to talk about solutions and addressing many of these problems. But let's underscore that critical situation in quite stark terms. We came across a study some years ago that had tracked the average temperature and the average precipitation in summer in the state of California over a period of hundreds of years. Okay? And what we found quite fascinating, thinking about the cause and effect, and here, of course, we are talking about climate change, was that there was a clear correlation, a clear trend driving negative outcomes related to climate change-related events. And I propose to you that following all of this analysis, we successfully identified the first corporate victim, large-scale corporate victim of climate change. So how did we look at it? Well, we looked at observations of temperature and precipitation in the state of California up until the First World War, so the turn of 2 centuries ago. And along the lower axis, you can see the precipitation, and along the vertical axis, you can see the temperatures in summer. So this was the cluster of observation over a couple of decades. And in the post-war period, what we were able to observe was that the summers were starting to become drier and hotter consistently over time as significant industrial activity was undertaken post the 2 world wars of the 20th century. More recently, that became quite an acute trend of even drier and even hotter summers. Can anybody tell me what tends to happen when you have hot, dry summers to an extreme in a place like California? Fires. Exactly right. Causing the loss of human life, quite tragically. And in 2017, we had some extreme forest fires. You probably saw that in the news. You've had your own forest fires here in South Africa. And in 2017, there was quite an extreme set of forest fires. Now, who here has seen the film, I'm probably showing my age, featuring a young Julia Roberts called Erin Brockovich? 1980s movie. Does anyone remember that one? I think she was at her finest back then. And so, from an acting point of view, gentlemen, she, of course, exposed a company called PG&E, Pacific Gas and Electric, and toxic drinking water related to poorly operated assets in their portfolio. Now, a colleague of mine and myself went to California some years ago. This is an exciting road trip, I must tell you. Didn't spend any time in the beaches or in Beverly Hills or on the Walk of Fame or any of that. We drove around the state meeting every single investor-owned utility. Pretty exciting, right? Not really. And there was one company that we really struggled with, and it was PG&E. Didn't really want to see us. You know, we're pretty hard-hitting in our questions, the way you operate your assets, your history. They've had other issues around a gas pipeline called San Bruno, which exploded, having been mismanaged, also costing human life. And they wouldn't see us. We couldn't really engage. We had a look at their operating practices, and we said, we're not seeing this company as investable. As it happens, by the way, an ESG ratings agency that will not be named ranked this company very highly, funnily enough. So illustrating the importance of actively scrutinizing sustainability practices. In any case, in 2017, we had these significant California wildfires, and PG&E was implicated in having sparked one of those major fires, okay? Because, of course, the company has these electricity transmission assets in very forested areas. They need to maintain the vegetation. They need to make sure their substations and their power lines are properly managed, they're properly insulated, and so on. And they were implicated, and there was a potential liability associated with them having sparked the forest fire. And as all of you know, in the United States of America, if you get sued, it can get very expensive. So subsequently, they had to eliminate their dividend for obvious reasons. And they managed to bump along for a little while until the next set of California wildfires in 2018. Because remember, those summers just keep getting hotter and drier and hotter and drier and hotter and drier. So that's the share price of PG&E. And very shortly afterwards, after having been proven to have been liable for starting these forest fires, PG&E declared bankruptcy. So had you been invested in this company, and I don't want to play down in any way the loss of human life, because here we're talking about investors losing all their money, but you are all investors, so we're going to make the point. The equity investor ended up with nothing, absolutely nothing. So that's a real example of how climate change can not only affect human outcomes, but investor outcomes as well. So scrutinizing these types of risks is critical, but more importantly, solving the climate change issue is becoming increasingly important. So the United States is not having a good go of things. The red line on this chart is the number of weather disasters classified as severe, costing more than $1 billion. And the red line is 2023. The other lines are prior years. So it is getting worse. It's happened in California, it's happened in Texas, it's happened on the East Coast, of course. And so the solution here that I obviously want to come to is the essential nature of infrastructure in solving the issue, whether it's drought, whether it's forest fires, as we've discussed, or landslides, or flooding, or hurricanes. You're all very familiar with this. And there's a wonderful quote by the executive director of the UN Economic Plan suggesting that infrastructure is a key to addressing the triple planetary crisis of climate, biodiversity loss, and pollution. And here in South Africa, it's pretty dire as well. This headline jumped out at us, where the country recorded more natural disasters in the last 12 years than any other African country. And that's the climate change-related outcomes that we face. And this, we're not going to pick on Eskom. I think that's been done enough. Maybe I will a little bit. This is not okay. We came across this chart of cumulative load shedding last year up until the date that Sandila mentioned. We couldn't get any more data from Eskom for some reason. It may be because they're embarrassed about where it's gone, or maybe they're just working very hard to fix the problem and don't have time to collect data. I'm not sure. But it's not okay, and I've spent more than 3 weeks in the country, and I've got to know this issue firsthand. I rented a little Airbnb for a few days, and I woke up one morning and there was no power. I forgot to check the load shedding schedule, and I wanted to make myself a coffee. And I thought, what am I going to do? There's no power. What do I do? What do I do? What do I do? So I thought, I know. I'll plug the kettle into the inverter. I have a feeling I'm going to get a big bill from the Airbnb host at some point for that misstep. But infrastructure, as we've highlighted, is the solution to the problem, particularly when it comes to the energy transition and addressing climate change through more sustainable forms of electricity generation. it might surprise you that roughly half of the investment in renewable energy outcomes is undertaken by the utility sector, mainly investor-owned utilities. So it's not governments coming to our rescue. And outside of that, you can see governments are typically only 3% of the solution around renewable energy. The rest is, as I say, utilities, financial players, households doing their part. Imagine households are doing more than governments, twice as much in solving the issue by installing their own solar panels and other sustainable forms of generation. So it is the solution, and it is an important contributor to achieving the Sustainable Development Goals. Now, in the fund that I manage, and we'll talk about it shortly, and we are unique in this way, we actually undertake an effort to measure the contribution to the UN Sustainable Development Goals and their associated targets. Okay, and this is really important because we have the overarching goals. Of course, we have the specific targets, which are classified by the numbers around the middle, and we measure how much of the Sustainable Development Goal contribution is made by each of our companies, revenue line by revenue line by revenue line, and then we disclose that. And we've done this in keeping with the framework that was published by the UN, and this revolves around not just renewable energy, but social infrastructure, drinking water, health, and even digital connectivity. You may have seen on the chart that Sandila put up that digital inequality is a major concern as well. And we address that, including here in this country, as you'll see in a moment. So today, we're very proud that the fund contributes, by way of its activities and the underlying assets, more than 80% to the UN Sustainable Development Goals and targets. And that, again, is something that we measure. So let's talk about how we invest, what we actually do. So we have a unique strategy in listed infrastructure. Some years ago, working at M&G, which has a private infrastructure group, we saw the opportunity to complement a private infrastructure, equity infrastructure offering with a listed offering that is global. Most private infrastructure strategies tend to be regional. Our strategy is global. Our strategy is listed, so we have the flexibility by sector, by subsector, by infrastructure category, and of course by region, to invest where we see the biggest opportunities. So it's very flexible, and the liquidity that it offers, particularly for institutional clients, allows for exposure to the asset class without having to lock up capital for long periods of time. And I would argue, and we have lots of evidence around this, that you're also accessing the asset class at much more advantaged valuations than in the private sector. And the reason for that is in private infrastructure, we have huge amounts of capital chasing very few assets. And so prices have been pushed up, cost of capital in that framework is very low, and so the opportunity set is very limited, and we know this from the conversations that we have with our own internal group and others. So the likes of BlackRock, the likes of Macquarie, the likes of Brookfield have been raising billions and billions and billions of dollars to invest in the infrastructure opportunity. And so the valuations as a result in the private realm have been pushed up. And part of why we know this is because private investors have been coming to the listed market and taking companies away from us. So they see the valuations being highly attractive, and they say, right, we'll make a takeover bid for that. One example that we have is a company that we invested in a couple of years ago called Vantage Towers. Vantage Towers had mobile towers throughout Europe and was spun off by Vodafone. So many of the telcos have been spinning off their fixed infrastructure assets to focus on subsidizing your handset and trying to take you on as a 2-year subscriber. And we were a cornerstone investor in Vantage Towers when it was listed. We've been following it for many years. We had a good, solid position. We did very well through that holding. And then one day, KKR, the private equity house, their infrastructure function came along and said, we'd like to buy that, and we'll pay a 40% premium for it. So, okay, and off it went. And that's just one example of what we've been seeing in listed infrastructure. So what do we actually invest in? Critical infrastructure assets, long life concessions, where the concession holder takes the ownership of the asset and operates it over a long period of time before giving it back to government, sometimes as long as 100 years. We have one asset in our portfolio, a toll road in my home country, which, by the way, is Canada. I am not American. I just need to highlight that. Canadians go to great length to make sure people are aware of that. So that was a 100-year concession. And finally, perpetual royalties. This is unique to our strategy where the underlying infrastructure asset is actually land holdings, and the royalty holder takes a perpetual cash flow stream from anything that's produced by third parties on those land holdings, whether it's mineral or energy or what have you. So very long life cash flows is the important common denominator for these assets, and physical fixed assets. Okay, I often get asked about construction companies, steel companies, cement, all these things. We don't invest in those kinds of businesses, even though they tend to benefit from an upswing in infrastructure spending, but they don't have those physical assets that give us the opportunity to harness very long-term cash flow streams. So we're talking 20, 30 type year cash flow streams, and that's why private investors are investing in this area. Sovereign wealth funds, pension funds, endowments, insurance companies have long-dated liabilities because people are living longer. They don't know what those liabilities are going to be, especially if they have inflation obligations. And so being able to capture reliable long-term cash flow streams, particularly ones that grow, is the way to offset those future liabilities. And the way I think about listed infrastructure for everyday investors is exactly the same. One day I'd like to retire, maybe here in South Africa. And in 20 years, I want to know that I have that cash flow stream coming from this asset class. So what do we invest in? We have three components to the strategy. Most infrastructure strategies only have one, the first one, which is often called core. We call it economic infrastructure. What would be very familiar to all of you if I talked about infrastructure, utility businesses, energy infrastructure, and transportation infrastructure. We sometimes think of this as old economy infrastructure, but of course it's extremely important, particularly in the utilities realm, to ushering in the energy transition and, importantly, as you all know, energy security. So we get a very healthy dividend yield from this component of the strategy. We only invest in listed securities globally, and we get a GDP rate of growth type increase in the dividend stream over time. We only focus on businesses that are growing their income over time. We're not just chasing yield, okay? Because again, when I retire, I want that higher cash flow in the future, not a fixed cash flow. And so we get dividend growth in and around GDP type rate of growth. And this, of course, importantly, also provides inflation protection. Growing income, the only way to properly insulate yourself against a higher cost of living. So that's all fine and well. This is important. This is critical to the functioning of economies. And for us, it's between 2/3 and 3/4 of the overall exposure of the strategy at any given time. But to this, we add an important, critical component of infrastructure that is key to the functioning of society, which we refer to as social infrastructure. You don't tend to find this in listed infrastructure strategies, but you do find a lot of it in private infrastructure strategies. Private equity infrastructure investors in things like hospitals, state care facilities, universities, schools, federal and municipal buildings, and so on. And we're able to access this component of the asset class through listed securities. What we get here is a real defensiveness in terms of the characteristics of the component, where we get a generous dividend yield that tends to grow with inflation protection. And this is an area that, for example, will do very well in a difficult market environment, such as the global health pandemic. That was the best performing component of the strategy in early 2020, when the world was spinning backwards and we didn't know how things were going to go. And these, in many cases, are referred to as availability-based infrastructure assets rather than demand-based assets. And what I mean by that is, for example, toll roads. You tend to get paid well if people are traveling on the roads, cars are traveling, cargo is traveling, so demand-based. Whereas social infrastructure businesses, typically, if the facility is available, you are getting paid, typically by a government. So during the global health pandemic, schools were closed, hospitals were obviously open, but schools were closed, municipal buildings were closed, libraries were closed. Not that anyone goes to libraries anymore, apparently, but we were getting paid for the availability of that infrastructure regardless. And then we get on to the really exciting stuff, the high growth structural opportunities in what we call evolving infrastructure, which mainly revolve around digital infrastructure assets. So without towers, without data centers, optical networks, and so on, we haven't got any internet, we haven't got any Zoom calls, we haven't got any dating apps for those of you that are single. We haven't got mobile connectivity. No, you laugh, but my kids would give up running water before they'd give up Wi-Fi. We were talking earlier about how none of them shower anyway. So transactional infrastructure also key, and Africa is a great example of how digital payments have facilitated access to banking services. So this is obviously very critical. And then those royalty assets that I talked about earlier. So what's really key about this strategy is that the underlying constituents of each of the three categories of infrastructure tend to move in different ways in different market environments. So we have a natural diversification across the three categories, across the various sectors and subsectors. Then, of course, this is a global strategy. So we are globally diversified. So let's take an example, a little case study, now that we're talking about digital infrastructure, where we actually do have some exposure here in South Africa. We own a company in the portfolio that we've had since day one called American Tower, which I keep saying is inappropriately named, because while they have 43,000 towers in America, they have nearly twice as many in India and in other various emerging markets where the rush and the importance of digital connectivity is obviously very clear. And for that reason, and because of that emerging market growth, as well as improving network density and the rollout of 5G and so on, they've been able to compound their dividend growth at a 16% annual rate over the last 6 or so years. So that's a very impressive outcome. And this is the kind of company that we invest in a listed infrastructure portfolio. So if we come back to those sustainable development goals, maybe a little bit on our process and how we think about it. I've already given most of this away. We analyze the revenue of every company on a line-by-line basis. We map those revenues on the underlying assets and activities to the sustainable development goals. We classify, we consider for portfolio inclusion, and then we maintain ongoing oversight of those holdings to make sure they continue to be doing what they're doing. And the outcome is, as I mentioned earlier, more than 80% of the revenue, the underlying revenue and assets under management of the portfolio contributing directly to sustainable development goals. So it's time to get optimistic, okay? Because I have a vision, after having spent 3 weeks here in this wonderful country, of how we can start to solve some of the issues with infrastructure. Surprise, surprise, how else are we going to do it? Now, I don't want to make in any way light of some of the difficulties that we all face. So this is partly tongue-in-cheek, trying to suggest some possibilities for outcomes, particularly around energy security. So you all know the issues, and please don't throw anything at me. Please don't throw anything at me, because I think the first step in solving the energy security issue in this country is actually centered around a fossil fuel. But it's not coal, it's gas. Can anyone tell me the fastest and most expansive decarbonizing nation in the world today? Clue, it's a big country with a large population. China, thank you. How is China decarbonizing more quickly than any other country in the world? It's not because they're building 32 nuclear power plants, which they are today, and it's partly that. And it's not just because they're rolling out a lot of renewables. It's because they are replacing coal-fired power, coal-fired chemical processes, and coal-fired heat in industrial and commercial applications with gas. They are buying all the liquefied natural gas they can get their hands on. The biggest buyer of liquefied natural gas in the world. It used to be Japan, it's now China. So building a regasification facility is actually pretty simple, okay? A liquefaction facility, on the other hand, is very complicated, because the way liquefied natural gas works, I'm sure most of you know, is you take raw gas from the field in Qatar, in Mozambique, in the Gulf coast of the United States, and you chill it to insanely cold temperatures. I don't even remember how cold they get, but almost as cold as a Canadian winter, apparently. You then liquefy it through that freezing, that cryogenic process, and you put it on these massive bubble tankers, and you ship it around the world. But a regas facility simply depressurizes that gas, brings it up to temperature very carefully, and pipes that gas in. And I've put some little power plants next to the regasification facilities that we can dot along the coast. Okay? Pretty straightforward. And what that does is it creates baseload. And it creates a lower carbon footprint form of power generation for the country than burning coal. Right, that's the first step. And then the thing we're going to do, and by the way, that's infrastructure. The next bit of infrastructure is a properly functioning long-haul transmission network, a grid that actually works and takes the electricity from the places where it's produced very efficiently to the places where it's needed. So this is a very important element. It's important alongside more efficient low-voltage networks. So, of course, high-voltage transmission lines carry the electricity for large distances. The low-voltage networks distribute it to all of the households and commercial applications. And they need to be solid. They need to be smart. They need to be bidirectional if we're producing our own power on our rooftops, right? What do you do with the excess energy? It's got to be sold back onto the grid, right? I saw lots of renewable energy up in the Eastern Cape, wind farms and so on. And you drive along and you see this array of wind farms, let's call it 10 turbines, and only 2 of them spinning. Why were the other ones just stopped? They weren't broken. They had the brakes on because there was nowhere for the electrons to go. You had excess power because you didn't have a grid that would take away that power and distribute it in the appropriate places. So then we got our low voltage networks, which means then we can start to build renewable energy assets all around the country, properly connected. As Sadila has pointed out at a very spirited debate at dinner the other night, it's like there is this massive resource, namely the sun. Thank you very much. I live in London, by the way. We're just learning what that is. We've got to make use of it. And of course, it's very windy in many parts of the country as well. And if you can connect that renewable energy appropriately on the network, you can do very well by it. And then, let's build some offshore wind too. Why don't we? We have a lot of coastline, got a lot of wind. There's a new technology in offshore wind, which is floating turbines. You don't have to fix them to the seabed because you've got a very difficult topology. Is that the right word? In the seabed, so we got lots of floating offshore wind. Connect that all up to the grid. Let's add a nuclear power station just for fun, just for a little bit more base load. I know we're really dreaming now. And then we can all enjoy a cocktail looking out at the beautiful sunset wherever we happen to be in South Africa. So that's the dream. But I think we're all very well aware that that's not going to happen anytime soon. But what's very interesting, and this is the little twist on the story, is that there is a country, points for the correct guess here, where I can put all of those infrastructure elements where they are actually in place or being developed at a very rapid rate and very successfully, including those LNG regas facilities up in the north. There's your first clue. Anyone know what country this is? It's not Holland. You're close. It's not Norway. That is the Atlantic North Sea. It's Germany, which, out of desperation, have had to really address their infrastructure issues because on a fateful day in 2022, the Russians invaded Ukraine and suddenly they didn't have any cheap, abundant gas. And they said, right, we've got to address this issue. And so they got to work. They had 2 LNG regasification plants built in 2 years. They were bringing gas in from other countries. They're reconfiguring the long-haul transmission network, extended the life of the nuclear, refurbishing their low-voltage networks, and building renewables as fast as they can. And as a global investor, we have had access to this opportunity through companies such as Ørsted in the offshore wind realm, Enel in the electricity transmission and distribution business, Elia in transmission, E.ON in distribution, and finally Sempra, which is a US company that liquefies natural gas. And so the real tragedy is that for a South African, addressing the issue in this country is not really possible through infrastructure investing, particularly in the listed realm, which highlights the importance of going global. And I don't see that as unpatriotic, because I think all of you really understand the challenges around infrastructure and how to solve them, but the investment opportunities tend to be international. So the investment opportunity today for us as a fund is that these kinds of businesses have been left behind from a valuation point of view. The utility sector last year had its worst underperformance period against the broader equity market in 30 years because, of course, everybody's chasing those sexy tech stocks. And the irony, once again, lots of ironies here today, is that these businesses are delivering better than they have in the histories of our holdings in the last year. So they are delivering, but they're not getting appreciated. And that for me is a great opportunity, a great disconnect. And as a listed infrastructure asset manager, I can rotate capital to take advantage of those opportunities very quickly by region and by sector and by subsector. The private investors are doing much the same. I mentioned earlier that BlackRock has made a significant move into infrastructure, again, in the private realm. They bought an outfit called Global Infrastructure Partners, which we knew very well. They were also buying some of our listed securities, by the way. And just to give you a sense of how big this deal was, the partners of Global Infrastructure Partners, individuals that started the business, as a result of this transaction, became the second largest shareholders of BlackRock. Can you imagine? It's a lot of wealth. And this transaction was done at a significant premium versus where you would typically see asset managers change hands. And so Larry Fink has made quite a few quotes about the opportunities in infrastructure. They're not alone. Brookfield's doing the same, a Canadian company. Macquarie's doing the same, Australian. I don't know what it is about Canadians and Australians' obsession with infrastructure. I really don't. I mean, as a Canadian, you're born with skates on and an obsession with infrastructure. That's apparently how it goes. And there are other players that are actively pursuing infrastructure opportunities in the private realm, as well as in the listed realm. Brookfield has actually been buying some listed securities as well and bringing them private, partly because then they can actually affect outcomes. So they actually have a fund called the Transition Fund, where they actually, quote, go where the emissions are. They buy the companies where emissions are high, and they change those companies through engagement, through direct ownership, to decarbonize them and achieve better outcomes. And this is an asset class typified here by the utility sector that compounds earnings, cash flows, and growth quite consistently over time. This is a 20-year investment horizon. Yes, there's a little bit of cyclicality in there, but what's wrong with an asset class or a sector that can compound high single-digit returns consistently over time? You actually, dirty little secret, you actually, over a 20-year period, can outperform the global equity market with a high-quality basket of utility businesses. It's amazing. It's boring. It's not as fun as chasing Tesla and NVIDIA and having all that fun, but it works. It works. It's like a long game of Monopoly, which somehow I always lose to my kids at. Maybe I should be proud. I don't know. So that's the chart here. The global equity market having returned 5% over the last 23, 24 years. The global utility sector, and this is all of them. This isn't even the best ones. I mean, we're active managers. We go and try to pick the best ones. It's actually outperformed the global equity market. You heard it here first. I'm going to conclude, again, on a positive note, thinking as a long-term investor, in keeping with this chart, with many of the driving structural themes that benefit the asset class and some of the various companies that we have listed here to take advantage of those opportunities. And we're talking about, of course, renewable energy and energy security. We've talked lots about that today. Haven't talked as much about transportation of the future, which is, of course, electrification of transport, whether it's passenger or rail or what have you. Increasing urbanization needs, particularly in emerging markets, requirements around transportation, infrastructure in particular, that universal connectivity that I talked about earlier, bringing digital access to the world, a more circular economy and the infrastructure that's required for that, whether it's around water or waste, and then healthcare infrastructure and demographic-oriented infrastructure to address the opportunity of an increasingly aging society. So we'll just give you a little bit of detail on the fund itself without being over promotional. This is a strategy that we launched 6.5 years ago. We started with zero capital. I was actually the first investor in the fund, technically, with 100% of my own pension plan. Now, I know you're much more diversified than that, but for me it works because I get to come in every day and manage my own retirement funds alongside everybody else's. We've grown the fund in the Luxembourg vehicle to $2 billion. Got another $1.5 billion in other mandates and other vehicles. So it's a $3.5 billion highly scalable strategy with, again, an objective to grow the income to our unit holders every year in base currency terms to protect against inflation and achieve a total return these days in the high single digits plus potential re-rating of the underlying assets. So it's a very exciting time to be looking at the asset class, to be looking at the strategy. And in US dollars, we've managed to deliver a mid-single digit return in the asset class versus the peer group of less than 1%. So we're very, very proud of that. And importantly, this is also a strategy that protects capital in difficult market environments. So when we get big downdrafts in equity markets, which if you read the tea leaves might be coming soon, it's a strategy that preserves capital, such as 2018, where the market was down 9%, the fund was down 4%, or importantly, 2022, the market was down more than 18%, and the fund preserved more than half that capital, being down 7%. But also in other years, demonstrating that we have upside participation because of that focus on growth in particular, and all the opportunity sets that I've been talking about. So I'm going to finish there. I'll go on to this wonderful image. This is a reflective solar array in the Nevada desert, I'm told. This is like fine art for me. I would go to an art gallery and just stand in front of this for hours. I know it's a bit weird, but I'm an infrastructure geek. So thank you all for your attention. I very much appreciate it. I think we're going to have a question period, actually. Yeah? Is that okay? We'll do that? Thanks, Nelly.
Oh, thank you very much, everyone. I hope you enjoyed your breakfast. And we'd like to reconvene the session. Thank you. I'd like to welcome to the stage Sonia Sanderson, a former colleague of mine. We've actually known each other for over 15 years. We worked at Momentum Multi-Manager together. And Sonia and I have interacted on a number of occasions within the industry, as well as within her position as Chief Investment Officer at the EPPF. Sonia has many years of experience, over 22 years of experience in this industry. She's been a lecturer at the University of Northwest. She holds a number of qualifications, including a master's in stats and economics. So join me in welcoming her on the stage. Thank you very much, Sonia. So the focus of this discussion today, ladies and gentlemen, is about how asset owners are adapting to changes to Regulation 28 since 2022, when the regulator increased offshore allocation from 35 to 45%. Now, as an asset manager, we've seen a number of our clients taking more exposure offshore. Sonia, how have you experienced this change? And what do you believe are the challenges that institutional investors, specifically retirement funds, face now that regulation has opened up?
Sure. It's funny, when the new Regulation 28 came out, I was actually still at Momentum. And I remember we were pleasantly surprised with the news to come out. And as I moved to a pension fund, I realized that the pension fund actually wasn't quite ready for this change yet. So it's a little bit that the industry has been advocating for more exposure globally, more allowable exposure globally. And then it's like catching that bus, and once you catch the bus, it's a little bit of, okay, now what do we do? Where do we go? Where do we invest? So I really think, the institutional investor landscape has been struggling to adapt to the fact that we've got this 45% offshore. It's a new realm, it's a new toolbox, so to speak, that's been opened up for pension funds. And what do we do with it? Do we have the right skills? Do we have the right service providers? Do we know how much offshore we should have? What's the impact on our local assets? What's the impact on our members sitting in South Africa if we put up to 45% of our assets offshore? So I think there's a lot of considerations. I think everyone is in a world where there's a lot of skepticism, as we know, in South Africa. Everyone's excited about the opportunity set, what it can pose for institutional investors, how it can enrich their risk-return reward from a pension fund. But there certainly is a lot of uncertainty around how fund managers are responding to it. Are all of them ready? Do we support South African fund managers? Do we support global fund managers? What does it do if money leaves our shores? What does it do to South Africa? Are we therefore almost being disloyal to the South African context and the challenges that we're facing? Should we rather invest in the real economy in South Africa? So a lot of those questions, I think, are what people are grappling with in the institutional world.
Yes. So from a South African perspective, and as a South African-based asset manager, well, I represent the South African-based asset manager, we've seen a lot of fee pressure across institutional clients. Is that something that is considered when South African asset owners are looking to invest offshore?
Oh, definitely. I'm surprised, again, coming from an investment management product shop into the institutional pension fund world. I'm surprised how acute that sense of costs are, that the value chain is getting squeezed and minimized. I suppose it was driven from a regulator perspective when default regulations came in, so it shouldn't be a surprise. And I think a lot of trustees and members and pension funds feel that that's the part that we control. You know, that's the part that's almost a sure bet. If you can save 1 basis point on costs, then you don't have to generate it from an alpha perspective, right? So,
yes.
So it definitely is important. Of course, it's not the only important thing. If you think globally, I mean, there's a lot of other things that I think pension funds are facing when we invest globally. In South Africa, they tend to know the fund management fraternity well. They tend to know the consulting fraternity well. They know the names. There's a level of trust in who M&G, who 91, who Allan Gray, who Coronation. You know, it's household names. People know them in the pension fund industry. Once you start going offshore, I think there's a lot of, well, should we trust these people? Do they really understand what we're about? Are we becoming insignificant to them? Because all of a sudden you're investing in a hard currency somewhere else, but you're coming from an emerging market currency perspective. So even investors like the EPPF with a lot of scale in South Africa, when you go to a global perspective, of course, because of our currency, you're much smaller. So will you get the same level of attention? Will you get the same level of service excellence if you invest offshore? The biggest issue, of course, is your members reside in South Africa. So your liability, I mean, we're a defined benefit fund, and okay, granted the bulk of South African pension funds are defined contribution, but your liability, however hard or fast that is formulated, is in South Africa. Your members, the bulk of your members are going to retire in South Africa. What does it mean now that you're looking at assets from a global perspective? It may maximize return, it may help you manage risk, there's more diversification benefits. I mean, there's a lot more impact that you can create, looking at Alex's presentation earlier. But what do you do about your membership here? What do you do about your societal responsibility here, your corporate responsibility to the country? So all of those things play into it. But yes, we definitely can't get away from the fact that costs are one of the important considerations in investing offshore.
Thanks, Sonia. Just listening to the presentation from Alex earlier, it was clear to me that it's a very unique strategy. And I was sitting there wondering, do we have enough manager research capability in South Africa to be able to spot those, innovative, unique solutions that can assist us as South African investors to add value to our members, not just from an impact perspective, but as well as from an alpha perspective? I mean, I've talked earlier about us having a 4.4% savings rate in South Africa. It's scary. What are your thoughts on that?
Yeah, we're definitely sitting with different skill levels in different places. I mean, our fund is privileged that it has an investment team of its own. Some other larger pension funds also have that, but a lot of pension funds don't have that benefit. So they don't have dedicated resources that on their behalf can go and do research. Yes, you will get expertise in the market, either multi-managers or consultants or their partners that can help you. But it definitely sort of lengthens the value chain of you connecting with people offshore and knowing them. I mean, the weird and wonderful names that have popped up in my diary since I've joined the EPPF from overseas that's wanting to see me, and it's outfits that I've never in my life heard about, and it's from all nooks and crannies in the world that's wanting to get assets from us. You definitely need resources to be able to scour the world. So what we like to do is we like to partner with overseas investors that themselves have the resources, the database and so forth that can look at it, but then we're very clear about defining the strategy that we want in the context of a pension fund outcome that we're trying to create, what that particular strategy entails, and then please go and look for the best service provider for me in the world that can execute on that particular strategy. So I think there's expertise that can help, but it definitely can't be the traditional game that we played in South Africa. And I also think that South African pension funds come from a very peer group centric perspective in South Africa, where even now still a lot of funds are managed on a balanced or multiple balanced basis. It's got pros and cons. I'm not trying to advocate for specialist versus balanced, but the point is, if you are coming from a balanced perspective, now all of a sudden you can go to 45% offshore, unless your balance manager is going to go to 45% offshore, or understand the role that they play in your portfolio and the risk spectrum that could open up for you. The balance fund perspective may not be the most appropriate solution for you anymore. So yes, it definitely requires pension funds to think about what exactly it is that they're about, what they're trying to achieve for their members, to get the right expertise in the room, or to invest in the right expertise so that they are able to find these gems. And I think by and large, South African pension funds don't have that skill in South Africa right now.
I agree, and I think it's important that you would then partner with an asset manager that may have local expertise, but also a deep understanding of global capability and innovation. So moving on to the regulator. So the regulator, in my view, has caused some confusion. I'm not sure if anyone else in this room will agree with me, but they've now said, we're allowing you to take up to 45% offshore, but we're also allowing you to take up to 45% into infrastructure, because we understand that there's a need in South Africa and we need to invest into the country. How do you view that, and how are you actually managing this from an EPPF perspective?
Yeah, we were in a fortunate position that we already were investing in infrastructure, unlisted, so not a lot of listed opportunities in South Africa, although that's also something that we're trying to work on and looking for some innovation from a pension fund perspective. We're working with other asset owners to see whether we can't create listed vehicles that will help mobilize more of the assets in South Africa, and then looking for expertise to help us manage those assets. But that aside, we were in a fortunate position already to be somewhat in infrastructure, certainly not to the level of 45%. But from my perspective, the more there's an unfettered, open toolbox where you can use diversification as a tool, the better. So we definitely got excited about the fact that 45 offshore, 45% infrastructure. I personally don't see it as okay, well, there's now 45% in both places, global and infrastructure. Now let's do the interplay between the two.
Either or.
I actually think it's in a world where our listed market is shrinking, it's a little bit more, while my listed market is shrinking, I need to have a 55% exposure in South Africa in any case. Do I move to more unlisted instruments, private markets in South Africa? And what sort of unlisted instruments would that be? Is it private equity? Is it venture capital? Is it infrastructure? And in that sense, we're very excited that we can put more in infrastructure because our members are asking for it. Our members are asking that we think not only about their retirement. Of course, the first and foremost priority is the fiduciary financial return. And for them to be in a position to maintain their purchase power or to grow their purchasing power one day beyond retirement. That's clear. But then they're also asking us, and can we at the same time make sure that we have a healthier economy? That we think about financial access, where previously disadvantaged individuals in our economy now also has access? Can we also think about their children one day and the legacy that they want to leave as members in the pension fund? So what sort of country, economy, climate, even a world are we going to leave for them? You pick it up in conversations. I mean, Europe is very strong, and the developed world is very strong on climate change, for instance. When we started talking climate change with our pension fund, you could see a lot of people are glancing over and saying, well, that's not our first priority. Yes, it's maybe a little bit warmer outside, but we don't actually feel that effect as much as we feel the societal, the load shedding, and by the way, everyone, as much as we Eskom Pension and Provident Fund, I cannot switch on the lights. I do not know how that works. Please don't come and talk to me about that.
Please avoid any questions related to load shedding.
But yeah, so we were excited about it. I think there's a lot more there for societal, environmental, meaningful, impactful things that you can do by virtue of regulations allowing us more into infrastructure. But we equally as excited about the fact that we can go to 45% offshore, because now we can really dabble in a much wider pool. I mean, in the past, we, for instance, as a fund, had a lot of developed market exposure, a little bit of emerging market to complement us. But because we're residing in a emerging economy, we didn't want to just put too much in emerging markets. So therefore, we're very developed markets centric, and also very equity centric offshore. But now that it's 45%, now you can really start thinking about other themes like infrastructure and property and a lot of other assets. So I think it's a good thing, but I think there's implications to it that people need to think through.
Yeah. So you touched on something very important, is that I think when following a specialist approach, most South African retirement funds tend to invest in the vanilla strategies that would give you a global exposure, not just focused on specific themes, as an example. We have other asset owners sitting in this room. So if you could maybe give some advice on, when looking at their offshore allocation, how could they implement an SDG type of framework or an ESG type of framework within that offshore portfolio or allocation?
Yeah, I mean, there's many ways in which you can do it. I think SDGs is but one framework of trying to articulate outcomes from a consistent way, that we're at least all using the same language. I think the first thing that is, well, since I joined the fund, that we spent a lot of time on was to try and be very clear about what's important to us. What are we about? What sort of outcomes are we trying to create for our members? And those outcomes are not articulated in South Africa we want this, and in offshore we want that. I mean, that's the way that we execute it, but they want certain outcomes. And those outcomes talk to more equitable societies, financial well-being, to a globe that is progressive, that is fair, where we can share health and fortunes together. And I mean, that's not South Africa or global, right? So I think you can be very clear about what it is that your sustainability approach is about and what you're trying to achieve. And that's certainly the journey we've been on. So which SDGs are important to us? Which SDGs do we think are the ones that we can meaningfully reach or impact? And also, which SDGs do we think really resonates with our members? Because you want them to stay invested, you want them to stay comfortable in their pension fund. And we articulated our sustainability approach around social matters, right? Yes. Getting more equitability from a social perspective, whether gender, race, I mean, lots of perspectives, but mostly those two. Then we talked about economic parity. In South Africa, economic parity, even the dispersion of how things were set up in the past, financial access, economic growth, all of those kinds of things will bode well for our members if we can help with that. And then the third one for us is that we think about environmental issues. So once you start spending time with members in the pension fund about why environmental issues matter, why the ozone changing or decarbonization isn't just a governmental issue or something that Europeans talk about. It's something that's real. It's affecting the competitiveness of our industry and the financial growth of our industry. And whether our futures will be set in a particular way, how we're going to experience things going forward. But it's got real competitive financial implications. Then you start articulating it differently. And then I'm still waffling and not giving you the right answer. And therefore, in the global space, those same things matter.
Yes.
Those same things matter, whether it's in South Africa or from a global perspective. I do think that the globe is in a better position, or maybe developed markets, I should rather say, is probably in a better position to execute on certain themes like climate change, decarbonization, all of the investment opportunities Alex was showing, that is investable right now, where it's less investable in South Africa, at least in a listed format. And the reason being that they've gone through their industrialization periods and they're at a point where they can now start decarbonizing. In South Africa, for instance, we're still sitting with our just retirement, justness of the retirement perspective. How are we going to get the justness in the economy? How are we going to bring everyone along on that journey? I mean, our constituency of members at Eskom, obviously sitting there working at coal stations, are we going to put them out of jobs just because we want to fix climate change? No, we don't want to. We want to go through a just process. So all of those considerations mean that on certain things, you can probably put a little bit more emphasis from a global perspective than a local perspective. I also think, given our history of apartheid and the South African context, we certainly have a unique set of inequalities that we still need to address. Yes, we've made progress, but all of us know we're not there yet. So how do we think about the uniqueness of what is a priority from a societal perspective in South Africa right now that maybe is less of an issue from a global perspective? Global fund managers will talk about diversity, equity, and inclusion. That's their theme, and what does it mean? We know that we're sitting with much bigger issues here from a societal perspective. Yes, diversity, equity, inclusion is a good catch-all phrase for it. But we're still sitting with people that don't have access to basic services. We have people that don't have education. We've got health issues. We've got a multitude of issues that we need to deal with in South Africa. We're the most unequal society in the world. So will we implement SDGs the same way in South Africa than we do globally? No, we won't. We want to be more effective on certain things in South Africa than from a global perspective. But I think who you are, what you stand for, what you're trying to achieve is where I would start with, or advise other pension funds to start with.
Thank you with that. I fully agree. So I think it's about taking a strategic and focused approach as an asset owner based on your members and the needs of your members when implementing your strategy across both local and offshore. Thank you for that, Sonia. So just going back to the listed infrastructure presentation earlier on. Now, for me, this is something that's a first that we're now bringing to this market and this industry. From listening to Alex, what do you believe is the investment opportunity set for the asset owners and asset consultants and multi-managers sitting in this room when considering their offshore allocation?
Yeah, well, with 45% that you can now invest offshore, it definitely is a much more compelling case to not just be equity-centric, as I told you we used to be in the past. That you can look at other asset classes, understand it more holistically, and also to very clearly some of the points that Alex made, to be impactful with where you put the money. You can get great financial returns, but you can also be impactful. So I'm very positive about, I, for instance, wouldn't prefer going into private or unlisted infrastructure globally, but I think it makes sense to go into private infrastructure in South Africa, given where we're at and where our market is and what we need to achieve. But offshore, I think it's a great opportunity set for various reasons. I mean, I didn't say it earlier, but as a defined benefit fund, we're always looking for that, and Alex made the point as well, like other insurers and other clients, we're looking for that long-term liability matching CPI sort of assets. That's one obvious investment reason. It definitely helps diversify, and also from a regional approach, it's not just concentrated in developed markets, it's actually capturing certain themes of areas where you can invest. So from a diversification perspective, I think something like that is appealing. But for me, the nature of it being listed helps a lot. I mean, although we're comfortable with whatever it is, annual or quarterly or whatever valuations, it's much better if there's a market telling you what something's price is on a real-time basis, right?
Yes.
So I think the whole price discovery around listed infrastructure is definitely much more appealing. You don't have to sacrifice on impact and what you can create from a listed infrastructure perspective. And I think the liquidity. Pension funds are always looking for liquidity. You need to make sure that you can get into and out of things. One of the biggest criticisms that we've had in our fund in going into unlisted investments, not just infrastructure, has been, what about liquidity? Our landscape is such that Eskom is possibly unbundling, and you may need to move portions of the fund to different areas. What do you do with liquidity then? So to have the ability to invest in real assets, all the investment potential that comes with it, without sacrificing impact. Yes, it may be impact more from a global perspective than necessarily focused in South Africa, but it's definitely very appealing for pension funds.
Thank you very much. So you joined the EPPF in 2022 as Chief Investment Officer.
That's right.
And firstly, I want to commend you and the team. You're one of the best run retirement funds in the country and have done a great job for your members. So well done. So you come from an asset management background, having worked at Momentum. So what would you have done differently? You know, coming in 2022, having looked at their investment strategy, what would you have done differently had you been there 3 years prior?
At EPPF specifically?
Yes, at EPPF specifically.
Ooh, lots of things.
No need to share any specifics, but you know, share what you feel comfortable sharing.
Hindsight is a terrible science. It's especially to look at my predecessors and some of the things I inherited in the fund. But overall, I think it's a well-diversified fund. But I think there's been geographical concentration to some extent because of the old regulation 28 not allowing for a more diverse footprint. But we bought into some ideas like, for instance, we had this developed market exposure globally, but we felt that China was always underrepresented in the indices.
Right.
It's the second biggest economy in the world, and yet it's not represented in the indices. Plus, from an asset matching perspective and going through our asset liability exercise with our consultants, we felt that we're missing out on the growth opportunity that possibly will help our fund. So that story, unfortunately, hasn't helped us a lot. So we probably have a little bit too much of a African rainbow story in our portfolios. That had mixed successes. Some of it worked, some of it didn't work so well. But geographically, aside from South Africa, of course, and some developed markets, I'd say not having the ability to look at other growth areas, frontier markets, the Asian markets broader than just China, for instance, certainly is something I would have liked to change. And then, of course, most of our assets still, global assets are still in listed perspective. So to look at the unlisted market is another area where we're looking at. So private markets, we've dabbled a little bit from a developed market exposure with the theory that private markets are mostly developed in those areas, North America and Europe, for instance. But if I look at returns globally, then there's definitely other areas that's got great growth potential for all sorts of structural reasons, urbanization and medical advances. I mean, there's the tech things that Alex was talking about. There's so much digitization themes, strong themes, that I feel like we've missed out a little bit on some of those opportunities. But fortunately, Reg 28 is helping us think about those things afresh.
Yes.
So those are some of the themes I think I would like to change with hindsight.
Well, thank you for sharing that with us. So one last question. So if you were the sole decision maker on the investment strategy of a retirement fund right now, and if SDG and ESG was your primary objective, what would be that asset allocation between South Africa and offshore, and then focusing in on how you would actually allocate offshore, given Regulation 28? What would you do?
I've got a cheating answer because I'm a defined benefit fund. My liability is sitting here. I probably will have close to 60 in South Africa for that reason, because we don't want to have an unmatched strategy too much. So we want to match the liability as closely as possible with the asset strategy. I suppose you're asking more in an unconstrained, not a defined benefit world. That's very difficult. It's again, hindsight will tell me I should have had much more developed market offshore exposure than South Africa. And even if it was emerging markets, don't just stick in South Africa, then at least have a broader basket. But I think given the Regulation 28, it's really up to pension funds where they see the opportunity. It's difficult to say, we don't think local offshore, what the percentages should be. Aside from the defined benefit realization, we don't think of it as two pockets. I mean, within there's so many subsectors of different asset classes, returns, geographies, and all of it. So we rather think within equity, local and global, how would we split it? And within bonds, local and global, how will we split it? So the continuum and the opportunity set, I think, has increased as a result of Regulation 28. So it's impossible for me to give you a perfect answer to that. But because of the fact that there's a real change in South Africa needed, because of Regulation 28 forcing us to still have a home bias, because of most of the members because of all of the members mostly in pension funds sitting in South Africa, except for a couple of people that have emigrated, of course, but mostly the liability is sitting here, and they care about what's going to happen with their financial returns, but also in the country that they're staying in. So I would say the majority I would still put here, even if it was an unconstrained regulation world, I probably would still have bulk of my assets here, but I'll definitely look for much more diversification from a global perspective.
Well, thank you for that, Sonia. It's been a pleasure speaking to you, and I'm sure everyone has enjoyed your valuable insights. If there are any China-related questions, you're welcome to direct them to Sandile and Alex, and I'd like to invite my two colleagues up onto the stage so that we could actually open up the floor now to the rest of you for your questions. Thank you very much, Sonia.
Pleasure.
We're open for questions, ladies and gentlemen.
Thank you. I never know how to use a mic, eh? Where do you put it on your chest? But yeah, I think I'm audible. So my questions are quite interlinked, and they speak to something that Sonia alluded to earlier. But I just want to revert back to you, Mr. Arujo. I wanted to understand the geographical makeup of the Lux Infra Fund. The reason why, I'll give it away, is because you had a slide there that had the dream, the vision for South Africa. So I want to understand how much of the fund is actually allocating to South Africa. And the reason I'm asking this question is from an institutional perspective. If you think about it, as a retirement fund investor, I had a conversation about this with one of my colleagues yesterday. And I'm thinking about it from this perspective. I invest my South African rands into your global Lux Infra Fund. You build a bullet train in Netherlands. I don't retire into the bullet train. I retire into Metro Rail. So there's a bit of a mismatch there. And that's what I just want to understand.
Yeah, and I'm sad to tell you that the South African exposure is next to nothing. And it's for a lack of listed investment opportunity. And I'm sad for that because I love this country. I've spent quite a bit of time here. There's such an opportunity set. And as we were sitting at the table, Sonia and I were talking about where these opportunities can come from. I mean, can you imagine if Eskom or other government-owned infrastructure assets were to come public, to come listed? What an unbelievable opportunity, because then you suddenly have access to capital, foreign and domestic, and accountability to shareholders, to equity holders that are in front of you and voting and ousting you and engaging as required. And so I wish it were more, because the opportunity set is absolutely enormous. But as of right now, it's very little. It's those few towers, it's a few construction projects from one of our French infrastructure businesses. And so to answer your broader question, the regional allocation is indicative of the opportunity set globally, which happens to be almost all developed market in terms of what meets our criteria, where we have the domicile of the company. But many of those companies, of course, have emerging market exposure as well. So there are a number of companies in the digital infrastructure realm that have African exposure more broadly as a continent. But it's 60% North America. The rest of it is largely UK and Europe, and then mainly developed Asia Pacific with small amounts of emerging, like some China exposure, for example. And I wish it were different, because the opportunity set is incredibly obvious here. And I think it was referred to as potentially disloyal or unpatriotic to go and invest offshore in a solution that could so capably be applied here in this wonderful country. But that's just the reality. But I hope you could go on holiday and take the bullet train for
Thanks. As a bit of a follow-up then, you mentioned in your presentation that some of the big boys are buying up kind of the counters that were previously there. Are you finding that your opportunity set has diminished, or it's perhaps just marginal?
It's marginal. Our investable universe, which is the one we designed for the strategy, is $3 trillion in market capitalization and hundreds of companies. Okay. And I have to tell you, when the private investors come and take listed companies away, you come into the office and the guys say, "Have you seen the news? Have you seen the news? 40% upside." It's like, oh, I wanted that for the next 30 years. I need to go and replace that. And one of the most annoying ones, I have to tell you, we had an investment in Sydney Airport, a single airport listed infrastructure business in Australia, obviously, from day one in the strategy. And it was doing very, very well for us. And then we had the global health pandemic. And you can imagine what happened to airport equities globally. But this one had a specific issue attached to it, in that the growth and the traffic driver for Sydney Airport was actually Chinese tourism, which went to zero. And so the equity value of that business fell significantly, required financial support from equity holders such as ourselves. The valuation was incredibly disaffected. We were adding our exposure on the view that ultimately something would work out. And then a consortium of pension funds this time, not private equity, came along and said, "We'll have that for a 40% premium, fine," but it was worth a heck of a lot more. We managed to push for a better price as equity holders, but that's annoying. I'd love to have that business in the portfolio. Luckily, we have a lot of companies that come public. I talked about IPOs such as Vantage Towers, which subsequently got taken over, but there are many others. And so from day to day, the investable universe adds a few companies, subtracts a few companies, but at the margin, it doesn't affect our strategy. It just means we need to do more work, go and visit assets, go and visit companies, and then take the decision to invest.
Any other questions? Oh, Gerrit, there we go.
Thanks. Alex, this is driven more by curiosity than anything else. From your presentation, I got the sense that ignoring the odd war or political upheaval, LNG is virtually an unlimited resource. I mean, there's enough around the world to basically take out just about coal in power generation, et cetera, et cetera. Firstly, is this more or less correct?
I'd say it's very true. I'm a big liquefied natural gas fan as a transition fuel, okay? I think replacing one prominent form of carbon-intensive power generation, let's call it for the moment, with another over the long term doesn't really ultimately help our goals. So as a transition fuel for the next couple of decades, probably, it's incredibly important. You know, we had a call with a company last night whose primary business is to deliver liquefied natural gas to islands in the Caribbean and elsewhere that are burning bunker fuel for electricity, okay, which is even more toxic and painful. And remember, we haven't even talked about air quality here and human health from that perspective. So burning something a little less offensive can be very, very helpful. My ultimate dream, if I can give you the ultimate dream, is that the fuel we burn is ultimately hydrogen, which can be produced at carbon zero using renewable energy resource. You're probably all well aware of the proposed project in Namibia, which would use solar power to electrolyze water, to create hydrogen, which can be stored forever, can be transported very easily and burned very cleanly in place of gas. And that's what you could use those gas-fired power plants for ultimately. That's the dream. I hope I see it in my lifetime for the sake of, you know, future generations, my kids and others and the planet over the whole. But in the meantime, liquefied natural gas, it's abundant, it's cheap, it's straightforward technology, it's very transportable. But as you point out, politics can get in the way. So there is now a moratorium on new LNG export facilities in the United States for various reasons. That constrains the supply, and it means that it needs to be built in other places like Mozambique, like Qatar, and other areas where you may not have the right governance and environmental controls and safety controls to manage these projects properly. And they're difficult ones. The liquefaction projects are difficult projects, especially offshore.
Okay, that was very interesting, thanks, and good to hear that confirmation. And then, Nelanie, if you'll allow me to be a bit of a glutton, can I sneak in a question for Sonia as well? At this, while I'm holding on to the mic. Sonia, a little philosophical question. Mm-hmm. Wouldn't you agree with me that over the last, say, 25 to 30 years, a huge injustice has been done to the average working person in the wholesale shift from defined benefit to defined contribution funds, and I'm meaning well-managed defined benefit funds. Don't you think people are a lot worse off in a defined contribution world than they were in defined benefit world? Your average working person.
Yes.
Thank you.
Simple, full stop. But let me elaborate just so I sound like I know a little bit more about it. Well, we always used to work on defined contribution funds, but I have to say the benefit structure that comes with and the comfort it creates for the member and the stress it takes away from members in a defined benefit world is it's next level. Since I've been at EPPF and experiencing the interactions and the conversations. Of course, defined contribution funds are more to protect the company and trying to get their balance sheets clean and all of it. So it's not a surprise that we're moving there. I also wouldn't be surprised if there's pressure in the system. I mean, two-pot and all of those things are not going to solve for everything that typical South Africans are asking for. I think there's an expectation of years now, this rainfall of money that's coming, and it's unfortunately not going to be the case. And then I think there will be more questions about the patronage of balance sheets and how they get involved and what businesses can do to help their members and so forth. So I suspect that conversation is something to come again for the future, but 100% agree with you.
I guess my question is for Sandile Nalini. It was the last question that you posed to Sonia, and I would like to pose that question to Sandile.
Sure.
It was last year when 91 came up with a number, 38% to be the optimal offshore allocation in their portfolios. I can't remember the science behind it, but I would like to know what that is for M&G.
So this is in a Reg 28 constrained fund. So one of the things that I think is missing from the conversation about how much foreign is, what is your risk tolerance? Because, under a wide range of scenarios and assumptions, beyond a certain point, there's a sort of flattening off in your marginal the marginal rand that you put offshore doesn't generate as much return, but gives you a lot more risk. So to put it another way, your efficient frontier flattens out, and we find 30% is probably where it would. So then we sort of started asking ourselves, what are other people seeing? So what is the science that they are using in their modeling? And the only way we can get to a number close to 38, so 35 would be the number, is if you make two assumptions. The first is that the equity risk premium in South Africa is permanently impaired. So we would say 400 or 450 basis points is probably where you are. If you say that's now 300 basis points, as well as your global equity risk premium, you boost that by 200 basis points, such that your expected real return on global equities is now 7.5, and your expected return on your South African equities is 5 or 5.5, then you get to 35%. But if you look at the history of the sort of the world, that's a pretty interesting assumption to make in the long run. Yes, it's not to take away from the extraordinary period that we've just come from, where global equities have absolutely trounced South Africa and actually EM. But if you decompose that, all of that growth has actually come from the US. So it's really just been American exceptionalism that's driven global equity returns over the last 10 years. But to even go a little bit more philosophical, if you're making that assumption that a supposedly lower risk asset is going to give you a higher return, then sort of have to go back and study a little bit more financial economics theory. It just doesn't make sense to me that we all know the manifest risks associated with investing in emerging markets in South Africa. Why would you demand a lower expected return to invest in that asset? That doesn't make any sense. Plus, if that's the case, then you probably don't want to hold any of it, because you can do much better holding global equities. So I struggle with that 38% number. To sort of finish off on the question, at the moment we think valuations are obviously a lot more supportive in SA. We think both bonds and equities are cheap, a lot cheaper than their global counterparts. If the situation reverses, we're very happy to back that signal and max out our 45% if that's the case. So if hopefully that comes true, Alex's dream is realized, and South African equities fly and triple in value in the next 5 years, then the valuation will come under pressure. We might start to look elsewhere. But strategically, I struggle to see how you get to 35%.
Any other questions? All right, I have a question, and I think this is off the back of my discussion earlier with Sonia, where we touched on the use of balanced strategies. So this is for Sandile. If you could maybe touch on China specifically. It's not China specifically. I mean, we recently took some exposure into China within our global strategy, within the Balance Fund. So if you could maybe touch on China as an emerging market and an investment destination for South Africa.
Well, I'll preface the answer by saying we already have implicit Chinese exposure via NASPER's process, via Richemont, via BTI. So there's a lot of, China sensitivity in equity markets and in the portfolios based in SA already. But the reason we took our exposure, from about 1% active in Chinese equities to about 3.5% active in January was twofold. The first is obviously we don't know what's going to happen, so we're not making a call on whether we think Chinese growth is going to go up to 6%. None of that matters to us. The reason we sort of got interested in China, specifically on a tactical basis, was because the equities had fallen so much. So if you look at the underperformance of Chinese equities, whether you're looking at MSCI or HSCEI, they had underperformed emerging markets, they had underperformed EM Asia that underperformed, South Africa, can you believe? And then obviously underperformed developed market equities. And part of that was explained by the fall in delivered earnings. So yes, there has been a massive disappointment in Chinese companies delivering earnings. But when we sort of spoke to our colleagues who look after Asian equities, one of the interesting things and the themes that were coming out was that they were finding Chinese companies listed in China, but with businesses or similar businesses elsewhere in the emerging market, and specifically in EM Asia. If you were listed in China, you were trading on a significant discount to a similar company listed in Singapore or in Vietnam or operating in Indonesia. The business model is the same. Sometimes it's actually the same company doing the same thing, but the valuation attached to Chinese stocks was significantly lower to ex-Chinese stocks. So that is weird, because ultimately what we're trying to buy are those free cash flows, and if the economics are the same, then the price should be fairly similar, or then you have arbitrage opportunities. So we sort of were interested in that. Plus, as soon as the price fell again, because you started hearing people saying things like China's uninvestable. You started hearing things like China's become too small, so you don't have to bother in thinking about China from an investment perspective. And people have basically capitulated on China. Those are trades from a tactical perspective that we absolutely love, because the price is depressed, it's unloved, you're unlikely to be competing and arguing with people about buying the stuff. Everyone's trying to sell it to you. And then what do you look forward to exit? Often those stories come right by themselves. So if you look at a sort of news count of stories around China, it's been deviating a lot. People were worried about growth, and they were worried about the level of interest rates to support growth, and they were worried about debt, blah, 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 blah. As soon as that sort of dies down, what you typically find is that the price then sort of settles, finds a bottom, and then starts shooting up. And the first 20-30% rally people miss, then you have FOMO setting in. Everyone wants to be involved because they missed the rally, and that's typically when we say, okay, think we've made enough money, we'll exit. Yeah.
Well, thank you, Sandile. And that then brings us back full circle to the point I made earlier at the start of this of this morning, is that with uncertainty comes opportunity. And that's what we see now in China. So thank you very much, everyone. There's one more question on that side.
Hi, this is for you, Sandile, again, sorry. I know you said events don't define your strategy, like your investment philosophy and process. But I think for the past 30 years or so, we've sort of been sure as to which political party will lead. We're just not sure about the person who will lead. But now I think it's different in a sense that we are not even sure of the political party or what happens. And I feel like, they are in term for 5 years. That's a little bit long term in terms of who leads or what type of sort of coalition we might have. So I just want to, firstly, which coalition makes you more nervous when you look at it in terms of the investment landscape? And what is the possible best outcome in terms of the elections, that is?
I was hoping to avoid an election question, but thank you for the question. So one of the two things that we sort of will be sensitive to is if there's wholesale changes in the direction and the speed of structural reform. So the Office of the Presidency has the Project Management Office, and they are charged and have been implementing all of the structural reform initiatives that have been identified in, was it the NDP 2030 or whatever it was. So if whoever comes in starts wanting to mess with that would be problematic. We think it's less likely to happen for two reasons. One is, even though you'd be forced into a coalition, we still think ultimately, whoever is going to be the ANC president come election day is going to be the national president. So the fact that they've built that capacity and professionalization within the presidency is, one side of a double-edged sword. If you have a benevolent and, fairly progressive minded president, it's great because they'll provide political cover and let them get on with it. So, we think Cyril's still that person. If, on the other hand, you have someone who's not as progressively minded or wants to use that power that's centralized within the presidency to do nefarious things, then we have problems. So, in a fairly cowardly way, I won't answer which coalition sort of makes me worried. I think what's important is to ensure that we carry on implementing the structural reforms. We carry on with, sorting out the logistics network. We carry on bringing in private operators onto Transnet's rail network. We carry on with separating Transnet, the operation of trains, for example, from operating the network, so the railway network, because then, you can have some competition and actually hopefully bring down the price of shuttling goods around the country. So coalitions are tricky. So you guys have, and I say you guys in Gauteng, specifically in Joburg now, but we saw it in Ekurhuleni and in Tshwane, have a very poor experience with coalitions. Obviously that is a worry, and that is a new thing, a new feature of this election that I think is right to worry people.
Thank you. Sonia, maybe a question for you, and as a result of the topics discussed with Sandile as well on offshore diversification. If you look at the South African economy in terms of diversification, so the majority of earnings on the South African Stock Exchange is derived from offshore. So you're looking at around 70% or so. And then when you look at the risk-return spectrum, the majority of the earnings that have come from offshore equity has been via the Magnificent Seven. So again, speaking through concentration in the US market. And my question is more a philosophical one. When you look at the asset management industry in South Africa, investors want to move to the 45% offshore allocation fully. So, I think the diversification element is overplayed there. And then how do you balance that with an emerging market like South Africa where, we're looking for transformation in the asset management industry. We're looking for job creation for analysts, people to become portfolio managers, especially on that offshore component. And then essentially you're creating a domestically focused asset management industry in South Africa. I mean, how do asset allocators think about that there? Because if they're going to be allocating assets to offshore investment managers, those offshore investment managers aren't necessarily concerned about transformation, CSI spend in domestic economy. Like the local SA investment manager would focus on disadvantaged areas, education spend. So how do you balance that out from an asset allocator perspective relative to diversification, which I believe is overplayed given how the earnings is derived in our economy?
Sure. Yeah, it's not I was saying earlier to M&G's CEO that that's the hot topic in South Africa right now from my perspective is what's the trade-offs of putting assets offshore? Yes, it's a dripping roast of opportunity if you're coming from South Africa, but what does it mean for our industry? What does it mean for our pension fund and society and so forth? The way we think about it is certainly that our first and foremost responsibility is to create the best financial returns for our members. To that extent, I see South African managers competing with global fund managers for global assets, and that they need to be able to go toe-to-toe with global fund managers to compete for it. Of course, it depends on what strategy, what asset class. I mean, certain things you can much easier do from South Africa with a smaller team, passive investing, smart betas, all of those kinds of things where you can use screening tools and so forth. But if you're really talking about people going to visit companies and looking at the infrastructure and, understanding what's happening there, then you want people on the ground. So we will always be looking for the best skill to be able to go and look for those opportunities. But we know that we've got a responsibility towards our financial services industry as well as our society for the reasons that you mentioned. So the way that we're tackling it is to try and find partnerships with offshore fund managers where they do put something back into South Africa, whether it's training, whether it's development, whether it's corporate social spend. I mean, we also have skills transfer in some instances to our team. So we're looking for our own team to be able to manage global assets at some point from a South African perspective. So transfer some of those skills to our team, and we see that as incubating new talent within our industry. So I think there's ways in which you can navigate it. I know of other big pension funds in the industry that put out specifically, here's a pot of assets that we will only give to South African fund managers with global aspirations. A little bit more playing from a societal perspective towards transformation and making sure the industry stays clean. And I suppose both approaches can work, but from our perspective, we're looking for the best talent, and we need to make sure that we get the best financial returns. I'd like to actually believe that on a lot of instances, or in a lot of instances, South African fund managers can go toe-to-toe with their global counterparts. There may be some areas where it's not practical, but I do believe that there's skill, and that it doesn't have to mean that we're sacrificing the good work that we've already done from a transformation and a gender representation perspective in South Africa. But it is certainly something where you sometimes do wonder whether the FSCA's goals of what we were trying to do in the industry and National Treasury were completely aligned in how we executed it. That there certainly is becoming a much more onerous competitive world for the smaller transformed managers, boutiques in South Africa to be able to compete with their global counterparts, that's for sure. But aside from them creating their own partnerships and skills, I've seen a lot of fund managers moving some of their team offshore, and they're managing assets from there. So I think our industry is in the process of evolution, and everyone's trying to solve for maintaining a sense of urgency and responsibility to a well-transformed economy in South Africa, but at the same time also making sure that we give the best to our members.
Thank you.
Right. I think that brings our session to a close. Thank you very much, everyone, for your time today, and thank you to my 3 guests alongside me. It's been a really, really great morning of some very useful and valuable insights, and we hope to take conversations further with you over this coming year. Thank you very much.
Thank you, Nalini.